impressive.
Absolutely.
I did email. Um, hey everybody, welcome to the live stream. It's been a while. Um, so Costa, he has a channel. Really smart guy, and I'm not just saying that because I've seen a lot of YouTubers, but he does know his stuff. I remember I asked him a question once, and he gave me a really good response. So that's how it made me feel even more confident in his skills. But if you watch his videos, you'll see what I mean. I was just asking Costa because there's a professor at NYU, Professor Damadorian. I hope I'm saying that right.
Yeah.
And he's like the god of valuation. What's his? There's like they call him
The dean
something.
of valuation. Yeah, the dean of valuation.
Indeed. And Bulldog Trading, what's up? Savvy Money Show. Thanks for joining, Rick, Marcelo. If everybody, Savvy has a channel, Bulldog has a channel. And something interesting, Bulldog streams 24 hours a day, 7 days a week, which is just crazy. He's always streaming. He obviously has a group of people, but it's pretty amazing. I reached out to, what's that?
I wanted to say, first of all, thank you for having me. And it's always good to set the expectations high by introducing somebody as an expert in some field. High expectations are always a good start. By the way, yeah, definitely Professor De Moron is one of the best when it comes to valuation. And I've actually reached out to him a couple of times over the last decade. Actually more than a decade. I initially reached out to him when I was a student with a couple of questions, and I mean, I really respect his willingness to help and answer questions. I think that's something that really stands out when it comes to him as a professor. I mean, those who have been in universities know that even their own professors sometimes don't have time, and let alone that he's not really my professor. He's just somebody who's on the other side of the world, and he's been so far an amazing human being, contributing a lot to the community. So it was definitely a pleasure to speak with him for an hour. And by the way, hello to everybody who's in the chat following this live stream. Feel free, by the way, to ask questions. We haven't really prepared topics up front to discuss. One thing that I would prefer is if we touch upon topics that are more broad, for example, accounting topics that are applicable for a wide range of companies, compared to let's look into one company or let's look at another company. Not only that, because we cannot do it, of course we can do it. The reality is, if we want to analyze a company really in detail, I mean, this live stream would be very, very, very long, because we will need to go into a lot of details. So we have to balance a bit of both.
That's true. And it's just kind of my thing. I wing everything all through college. Kind of, I mean, I probably shouldn't do what I do, but just kind of like studied the last minute. Even when I did business ventures, I felt like I got more done when. I mean, you want to prepare and be knowledgeable, but I felt like most people who I dealt with in life, they over prepare. Like they'll spend like sometimes years trying to like think every scenario. I just kind of jump in, and I don't really ever prepare anything for these live streams. Same thing when I do a video. I don't really do much research on a company. I just have my basic knowledge of the company, and I know accounting pretty well. But that's kind of like I wing most things. But I'm not sure if that's a good thing. So feel free to just throw out questions. We didn't have that much prepared. But I like things, accounting questions. When I get deep accounting questions, especially things I could learn from. So feel free to ask anything. And Costa's really good at accounting as well.
Yeah. Thank you. Thanks, Rick. I'm glad that I know you because you're a subscriber of the channel, and oftentimes you do comment to the videos, and I appreciate your comments, of course, but just engaging in general. I think that one of the roles that we have as content creators is to really create a community where everybody it feels free to express themselves, and then kind of get the response on the other side. So I try my best to respond to everybody, and I appreciate all the comments that I get. Now, when it comes to the accounting topics, I think one that I see very often a bit misunderstood is the stock-based compensation. So if there's interest from viewers, then I'm happy to share a bit more about that, because I think it is a topic that on one side gets a lot of attention, while it's not really that big of a deal. So I'll let you, as the viewers, decide whether this is something that you're interested in to kind of learn more about. If not, of course, that's perfectly fine. We can move to other topics.
Yes, SBC, stock-based compensation. That's a really interesting thing, and especially when you look at a company's income statement and statement of cash flows, most companies, especially and lots of like even startups, like you'll look at. Let me bring open Excel. In case anybody's curious, I don't know if anybody was. Wait, why doesn't it? Let me just share the screen differently. I don't think I set it up right. In case anybody's curious, why I'm not doing a video every day like I used to. Mainly, I've been playing a lot of poker lately, and it kind of consuming me. This is I do like, I'm trying to like get better at the math part of poker, like doing the odds and like stuff like that. I used to play a ton of poker 20 years ago when it was really popular, Poker Stars, but I just got back into it. But anyways, enough about me. But if you want to talk about poker, it's one thing I really enjoy. I actually, anything gambling related, I really enjoy. That's why I think I'm good at math, is because I calculating odds. But yeah, stock-based compensation is an interesting one because you might see a company with like say net income for the quarter of 10 million, and then you'll see operating cash flow of 100 million, and well, can anybody tell me give me some examples? I mean, there's a lot of examples, like why a company would have operating cash flow so much higher than net income. And remember, net income is operating cash flow. The way I think about it in simple terms, net income is operating cash flow is net income converted to cash. That's how I kind of think of operating cash flow. Because
Well,
net
except you
income
have to adjust a bit about the financing part, because there's also the interest in between, right? Maybe the operating would be a bit more accurate after adjusted for taxes.
What do you mean interest? Interest on the debt, or?
Yeah, interest on the loans indeed, because the net income is really the bottom line, and that the interest payments, for example, do not flow to the operating cash flow. That's part of the financing segment. So there can be many reasons.
Well, you don't do GAAP accounting. You do IFRS. I think it's slightly different in your country, but are you talking about GAAP? Because anything.
So it would be slightly different, of course, but it still the net income. I think most of the times EBITDA is to some extent a proxy. I don't think anything from the income statement would be one-on-one with the operating, of course. There are many reasons. I guess you were aiming to get to the stock-based compensation, as well as, for example, working capital adjustments such as increase or decrease in inventory, receivables, and payables that are not
I
reflected
mean,
in the P&L, but
well,
are reflected in the cash flow.
no, I know. I'm just saying this. It's definitely not exactly because I could think of a lot of things differently, but just to simplify it for like a conversation. So
Okay.
operating cash flow is net income, and then you have to add or subtract, you know, non-cash items from non-cash items from the income statement, and then you have to then add, subtract, change the working capital.
I would agree,
That's pretty.
yes.
That's pretty
More or
much
less.
operating cash flow.
To some extent, yes. To some extent,
I mean,
yes.
right? I mean, it's not. There's always going to be nuances, but just to like
Yeah.
simplify it, to have a
Yep.
conversation on a basic level. That's how I say operating cash flow is net income converted to cash. Just a really basic way to just think about it. Um, so, anyways, so I was just saying. Um,
So if you want, I can give an example when it comes to stock-based compensation, just to explain a bit more about it, because I do see, of course, a lot of tech companies do use it, and some of them are being criticized in a way that, okay, stock-based compensation is too high, a lot of expenses are being used that way. And I think the best way to really understand it is if we take a step back and think about what it is, right? So
yeah, let's do
what
that.
is it?
Let's define SBC.
So, Scott, you imagine that you want to start a business, and I gave the same example yesterday on another live stream, and you want to start a business, and it's a simple business. All you need is a website, but you have no clue how to program. You know, it just you don't have that skill. So what you need to do is you need to hire somebody to build that website for you. But let's also assume that you don't have cash. So what are the options? Well, you could offer that programmer, that web developer, a percentage in the website in your company as a compensation, right? So now you have a website, but you own, for example, 90% of it. The web developers own the 10%. And it's a fair deal, right? Now, in which case would the developer agree to do that? Well, the developer would need to believe that the website will do well. Otherwise, if it is a website that's going to crash, well, that person will have 10% of nothing. So this is similar to what happens in the large companies. Take a look at Palantir that had a lot of stock-based compensation. Their employees are being compensated in a comparable way. Some of them get paid mostly in cash, some have less in cash and more in shares, and the other way around. So ultimately, if you are on the other side, an employee, what is the reason that you would accept stock-based compensation, right? Well, you want to have some sort of compensation. You you would not work for free. So if you think about the big picture, stock-based compensation can be very helpful to align the interest of the employees with the shareholders, because now everybody has the same goal. They want the company to do well. They want the website to do well. They want basically they're on the same team. And in addition, for what maybe is not that publicly known because it's just not being that much paid that much attention, there are the stock-based compensation in the form of shares. So Scott, for example, you're employed in a company. After a couple
Yeah.
of years, you get shares. You can cash those shares out, and basically, you don't have to stay anymore. But at the same time, there are other types of shares that are vesting, so you're kind of motivated, incentivized to stay. And when it comes to stock-based compensation that comes in the form of options, that's a different topic, and it's equally important. And I'll give an example. So let's imagine that you are part of a company, and I mean, just choose a company. Let's say that you're in, shall we use Apple as example?
Yeah. Yeah.
So Apple's share price at the moment is roughly $190 a share. So you get offered a package as part of your compensation. And Scott, now you're being granted the option to buy 100 shares of Apple at today's market price in 190. And you might say, well, wait a second, I can already do that. So this is not really something that is useful, right? Well, it isn't, but you have the same option that you can use over the next, for example, 2, 3, 5 years. Now you have the option to buy Apple shares at the price of 190 a year from now, 2 years from now, 3 years from now, 5 years from now. Of course, it depends on the types of contract. So you're also incentivized to stay. You're incentivized to do well, so the company gets better and the share price follows. And when the share price increases, well, you also win, you also win. It's not only the shareholders. And yes, it dilutes. But if you think about it, if you're an employee, why would you work for free? Well, you wouldn't, right? So you want some sort of compensation. If it's not in the form of stocks or options, you would want to have that in cash, right? So eventually you will get compensated one way or the other. So it is something that the company anyway has as an expense. So I see an argument, hey, the stock-based compensation is too high. Sure, they could lower it, but how would you lower it? You would have to pay the employees in cash. So ultimately, you still have to pay it one way or the other. And by the way, I would not agree with that row there that the stock-based compensation does not hit the income statement, because it does hit the income statement. There is also a line stock-based compensation there. Um, it doesn't hit the free cash flow because it's not a cash expense. It's not a cash movement. It's
No,
not
it
being
does
paid
hit.
out.
Wait, SBC does hit the income statement only when the employee receives the stock.
No, no,
It,
no.
it
They do hit it. It does hit over time. So, for example, if you have shares that vest over the next 3 years, you will have an expense every year in the next 3 years.
yeah, but if you
So
if
it
you
does
pay
hit the.
if it, yeah when it no if I gave you a million shares in my company, but it doesn't vest until you're at the company for 5 years.
Yep.
After your fifth year, you get the million. It won't hit
Sure.
the income statement until that you
No,
get the.
that is not correct, Scott. You get 1/5 of the expense on the income statement for every year over the next 5 years. That is basically what is the stock-based compensation on the income statement. So that is the vesting percentage over every year. So you do get hit. The dilution doesn't happen until the options are received, are used, or the shares have been received. So that is a bit of a difference. So it's the vesting period is one thing to keep in mind, and that is the expenses being allocated over that period. The actual dilution happens when the shares are being granted the shares, or the employees are granted the shares, or the options are being exercised.
Okay, it doesn't hit the income statement until it vests or it's exercised.
No, no, that's not correct. It does hit the income statement. It doesn't hit the number of shares outstanding on the balance sheet.
um, wait, you're saying it doesn't dilute shareholders until. Wait, say that
So
again.
I'll give you an example. If the example that you used, it takes 5 years to vest share, right?
Right.
Basically, every year the company recognizes 1/5 of that as an expense in the income statement, with the other part being kind of in equity of the company.
Right.
The only
Right.
thing is that that share will be owned by the employee at the end of the 5 years. But on the income statement, you would see that. So it's not that you get some kind of a surprise after 5 years suddenly. It is distributed over the time, because accounting wise, you have to distribute or allocate the expense over the time that the
Until
expense is actually occurring. And in this case, it's 5 years.
vests. Me, I just in my head, I understood it. So let me say it. Okay, it doesn't hit the income statement until it vests by the employee,
No, no, that's
and
not correct, Scott. It does hit the income statement while it vests every year.
while yeah, while it vests, but
While it vests, not after
like
it vests.
when it vests. So
No,
say
during the vesting period. So in your example, if it takes 5 years, if somebody is granted shares after 5 years, in year one you do have an expense in the income statement. In year two, you do have an expense.
So if I give you a 5 million shares over 5 years, it hits the income statement 1 million shares per year for
Yes.
5 years.
Yes.
Right. When invest each year.
No, you recognize the percentage of this whole vesting period that it vested in that particular year. So 1/5
Yeah,
vested in the
1/5
first
per
year.
year.
Yes.
Okay. Me, I'm not saying right, but yeah, 1/5. It hits the income statement 1/5 each year.
Yes.
Um,
So it does
okay.
hit the income statement. It would not be accurate to say that it is not in the income statement at all until it vests.
No.
That's a great question, Bullock. What if an employee quits? There are two main you can there are two basically reasons why an employee would quit. Like basically the word quit means that the job the relationship between the employee and the company it is completed. There's no more relationship. There could be two reasons. One is retirement, right? In a way, the contract stops. In that case, in most cases, the employee continues to gets the options and can use, for example, over the next years as initially discussed, because the contract ended, but it's not because the employee left. It's just, retirement is part of life, right? On the other side, if it's if the employee leaves, well, in that case, that's it. There's no more. Even if somebody had 2 out of the 3 years of that particular plan to get the shares, that's it. That person doesn't get anything. And this is kind of in a way a plan to incentivize employees to stay within the company a bit of a kind of a longer period of time. So they're not only incentivized to do well, to make sure that the company does well, that will reflect in the share price, but also in order to use the shares to get the shares or options in the future.
Right. If I hire someone to if I start up and I hire someone, I say I'm going to give you $50,000 a year, and I know it's not a lot, but I can't afford more. But I'll give you 5 million shares, and they invest over 5 years. They have to stay the 5 years to get the 5 million shares. That's and like for accounting purposes, each year 1 million shares hits the expense part of the income statement. It's a non-cash item. So that's why net income is dragged down, because if I have 100 employees where I offer this every single year, that's 100 million shares on stock-based compensation that are an expense that bring down our net income. But we add it back on the operating cash flow section because it's a non-cash item. So that's why operating cash flow sometimes is so drastically higher than net income.
Sure.
But then after 5 years, a lot of these shares, it doesn't affect our cash as a company, because when you give stock, it's not taking money out of the company, but it's diluting shareholders. So it does have a negative effect.
Sure. Oh, absolutely. Absolutely. But if you think about it, this whole the same employee, if you would not pay that person the 5 million, why would that person work for? Well, it would say, well, just pay me in cash, right? So one way or the other, you have to compensate that employee. I think it's a bit of a myth that stock-based compensation can be magically lowered without taking any further expenses. So yes, it comes in the form of dilution. It's one way to kind of compensate the employees, but yeah. Yes, Bullock, you're right. If on year 4, if any time throughout this period the employee is fired or quits or whatever happens that terminates the employer relationship, the everything that has been booked accounting wise is being reversed. So you would see the opposite of the stock-based expense, kind of a positive in the income statement. And by the way, Neil, could you maybe elaborate a bit more on that? Because it's a one sentence. I'd like to just understand your thought process, and maybe I can share my thoughts.
But it is a good way to lock employees in, because a lot of people will probably, if you didn't want to be at the company and it was year 3 or 4, I know a lot of people who stayed until they got
Sure,
their bonus at a job, or they stayed for a certain landmark, and then once they got that
sure.
money, then they left.
Yep.
But it is a good way to get people on the same level. But a lot of people became millionaires at companies who shouldn't have been millionaires, like people like secretaries, because the company couldn't afford to give a full salary, so they gave a partial
Well,
salary and stock-based compensation or options or something like that. And a lot of
I
these,
would I would
what's that?
disagree with that, by the way. I would disagree because I think it doesn't matter of the role everybody is adding value, and anybody who's accepting stock-based compensation, it's kind of a two-edged sword, right? You could become a millionaire, but maybe the company will go bankrupt and you get nothing. So there's a risk in that as well.
Yeah,
So
it
if
is
you
a big
take a
risk.
look at, for example, if you take a look at Zoom, right, its share price went up a lot during the pandemic, and a lot of employees got options. I mean, the share price is significantly down. They're not going to be using those options anyway. So
Right.
their bonus, their compensation in the form of options, yeah, I mean it's worthless. So there is a bit of luck involved in it in terms of timing. There's always risk. I mean, there's nothing risk free, right?
Right, right. Of course, yeah. It's just like investing in a stock. There's no guarantee you're going to make money. You might lose it all. Just like working at a company, if
Exactly.
they offer you $40,000 plus $10,000 in stock instead of 50,000, it's you don't have to take it. You can find another job, but if you take it,
Exactly.
it
No, there's always a
could
risk.
work
I
out.
agree.
Yeah, yeah. But anything. What was I gonna say? Yeah, generally, if a company's stock price is going up a lot, like in a bull market, you'll see people exercise their options, whether it's an employee or somebody bought options in the market. So they're more likely to exercise their options as stock price goes up, and it becomes. Uh, but when a stock price goes down, the opposite happens. There's no reason to exercise.
Yeah.
Um,
And some are even out of the money. You can't even exercise them because
yeah,
the share
you
price is
can.
below the strike price.
Right, right. I mean, if anybody bought options, is anybody familiar with buying options? I know covered calls. When I first learned about options, I did different types of options, but mostly covered calls. I don't do it anymore. Um, I don't see as much of a benefit, and I know people think it's free money, but when your stock goes up a lot and your shares get taken away from you because you put a covered call on, you'll realize it's not free money.
I mean, there's
Um,
no free money, right? I mean, if something sounds too good to be true, then it's just too good to be true.
right.
Um, so yeah, yeah. I mean, I don't provide any financial advice. I think everybody needs to find what works for them, and if that's value investing, so be it. If that's options, so be it. I mean, you need to
Right.
figure out um, what is actually the best way that works for them, and that they can sleep at night as well.
Yeah. I
They actually, so the question of bulldog trading, when employees have options as compensation, can they sell them on the open market or do they have to exercise? The answer is they have to exercise, but it's kind of comparable to selling them because basically, let's assume the example that I gave. You have the option to buy Apple at 190, and today let's assume that it's at 300. So that difference of 110, well, that would be also the options price. So you could actually buy Apple for pay the 190. Now you own Apple's share of 300. You sell it in the open market, and you kind of collect the difference. So in a way, you kind of use it, but it's also on the open market because it really depends on the price, the market price at that moment.
yeah, like if you bought like a call option through E-Trade or whatever, that's a security you can trade in open market. But if you received options or you received debentures from your company, you can't trade it in open market. You can't like sell it to like somebody else. It's not tradable.
No, it's not
um,
tradable, but it's comparable to the options that are out there in a way. But
yeah,
it's
it's a
actually a bit different in terms of
yeah,
the time, the time differs. You have a certain period of time to exercise it. For some, it's 2, 3 years. For some, it's 5. And I've seen some that are 15, 20 years. Now, that is a very long time frame. So,
yeah. But it's definitely the same characteristics as an option, with the same terms and strike price as you would an open market, the same kind of like volatility, but you can't trade it.
Bullock, what do you mean are not represented in the open interest? You mean as outstanding
That's correct.
shares?
Yeah, they wouldn't be part of what you see on open interest when you go to like buy options on a website. That's not part of it.
No, it's not. It's not part of any open market. What you can see is in any an annual report of a company, you can see the outstanding options that have vested, so the employees can use. You can see the average strike price, and you can see the average duration, so for how long they can exercise it for. Maybe Scott, if you want, you can open one of the annual reports and we can look into that. Or if you want, I can. I don't know if. Yeah, I can maybe send the link to you private in the chat, and then you can open that one if you want.
Yeah. So if you see on most income statements, it says basic shares and diluted, and then it'll be like 1 billion basic shares, and then 1.1 billion diluted shares. So that means if all the convertible securities, that means there's 1 billion shares outstanding trading in open market. If you own one of those shares, you're one of those 1 billion. But there's people who own convertible securities where they can convert their either debt or they can convert that security to equity. All the employees' convertible securities are part of that diluted. If you know what I'm talking about on the income statement, I talk about it in my videos a lot. When I look at the income statement.
Yeah, so you're right. The difference between the two is all the kind of securities that eventually could lead to dilution. Stock-based compensation is one of them when it comes to options. It could be some sort of loans that could be converted. It could be preferred shares that could be converted. It could be warrants. So there are all kinds of different
everything. Yeah, not just stock-based compensation. Stock-based, like in this particular example, that this employee has 100 million securities that could lead to that could be part of the basic securities that trade in the open market. But of these 100 million, maybe like 30 million are employee stock options. I don't know. I'm just making a number.
Yeah,
but,
sure. And
but,
you can find
it could be all of it. It could be, but I'm just saying. I'm kind of tying into what you said. You can't. It's not a trade in open market, so you wouldn't have a visible. But Costa made a good point, which I never really even noticed, is that you can apparently on their annual report you can see how much stock-based compensation.
Yeah. Yeah, I mean, I can quickly open one. Maybe I'll just take one and I'll send you the link.
And when you look at an income statement, usually, usually has like revenue and then cost of revenue, then gross profit, and then it has all these operating expenses like SG&A, selling general administrative expenses. Then you may have depreciation. But within every expense item, there is stock-based compensation. Like within SG&A, if an employee is working in a marketing department, their stock-based compensation is part of this SG&A expense on the income statement. And then if you have like other expenses listed out, the employees who work in that part of the company, and you can even find it on the income statement. It says how much stock-based compensation for each of these areas of the income statement. I've shown it in some of my videos. Not all companies provide that detail. VinFast.
I'll, by the way, send you a link to the Palantir annual report, and then you can look into. Let's see. Can you open, by the way, the link? I don't know if you have access. Probably you have.
Did you email it or you?
I
You
sent
put
it
in.
in on the chat in the streaming
Oh
link
yeah,
that you
here
sent.
it is.
So if you go to, I believe it's page 107. I think it's interesting to see that. So it starts somewhere from 106, 107 is the
I probably could just
you can
search.
type, I think, all the way. You can, never mind. You can type in the top where you see the page number. See the 54 that is just. No, I meant. Um,
What's that?
just below the taskbar, that you can see the number of pages. It says 78, 80 something out of 139. But okay, you're anyway quite close.
107.
Yeah, so if you scroll a bit below, there should be stock options. For example, this is one segment, and you can see how many stock options there are options outstanding at the beginning of the year or the end of last year. You could see how many have been exercised in the whole year, how many have been
Yeah.
canceled and forfeited. So that canceled and forfeited is basically the ones that have been kind of canceled and forfeited by employees leaving the company. And then there's the balance of all the options out there, 326,913. Out of those, 183,119 are vested and can be exercised at any moment. And you can see that, for example, this is for Palantir. The average exercise price per share is 5.77. So 183,000 shares can be exercised at any moment. This is basically, of course, as of the end of last year, end of 2022. And then you can see also that the average contractual life, that's the next one, 7.43. On average, the employees have 7.43 years to exercise these options. So over the
Yeah.
next 7.43 years, on average, they can exercise these 183,000 options, buy a share of Palantir at 577, even though the share price today is, for example, 15. And this is one
Yeah.
segment, by the way. If you go below, probably are restricted stock options or stock units and so on. So this is purely related to stock options. See, there's the RSU. That is basically the
Stock units. Yeah.
yeah.
And this is 326 million because it's thousands. Just in case
That
anybody's
is the
curious.
number that is both vested and is vesting at the moment. So maybe some of those, you remember the example, the first 5 years, for example. Well,
Yeah.
some of those are past the 5 years, some maybe in the third year, some maybe in the fourth year. So
Yeah. So in the beginning of at the end of 2021, 350 million options outstanding, 20 million exercised
yeah,
by the employees, 3.4 million because employees left or something happened, may get fired. I don't know.
yeah,
So now there's 327 million options outstanding at the end of 2022, and not all of them are
yes,
vestable. Of these 327 million, 180 million are vestable, and
are vested, yes,
140
exercisable.
they can be exercised if the employee wanted to. Obviously, that means 140 million. Even if the employee wanted to, they couldn't. They might have to wait a certain amount of time, or maybe they were so far to. But why would? But you might be thinking, why don't they just exercise if they can?
They can.
Why don't they just do it? Well, maybe because I worked at Chase, JP Morgan Chase, and I had shares of stock, and I didn't just sell them as soon as I could because the stock was, I want it to go up. Just like if you own stock, you don't have to sell every share you have. Maybe you think it's going to go up and you're bullish. So they might be bullish.
Yeah, but also you don't have to. So I think there's another reason also. If you take a look at the weighted average contractual life, right? So that's 7.43 years. So the average employee there that owns a part of those shares has 7.7.5 years to buy these shares. So if you buy today, tomorrow, or in a year from now, basically you own the same share. The only difference is if you buy it today, you have to pay the 5.77 per share today. You can pay it in 2 years' time and you would still pay the 5.77. So
Right.
why would
Right.
I pay today to have the same share that I would pay exactly the same to own in 2 years, in 3 years, in 4 years time? So it is a bit different because in this case, you don't have the share. You have the option to buy a share at a predetermined price. In this case, of 5.77 is the
Yeah.
average. So some might have it at 5, some might have it at 3, some might have it at 11.
Right. Right. But like I was saying, you can just what a lot of people do is this: they say, okay, I'll buy the share 577. Let's assume the person I'm talking about
Sure,
is at the average, and then just turn around and sell in the open market for
sure.
15, which a lot of people do. But if you think the stock will go up, like you're like 15 is so low, it's going to be 50 in a few years, so you might
Sure.
not see a point. And then another reason, there might be some people who are really high up at the company, like the CFO or the chief operating officer, and they know they can sell. But they're kind of like not told not to sell, but it's looked down upon when a really high level person sells a lot of their shares because it looks like maybe something's not right with the company. So even the CEO, even if he wants to sell a stock, he might not, just because he doesn't want to get like yelled at by people like, why are you selling your shares? What's wrong? Something's happened with the company. So there's a psychology part of it too, which
Could
I'm
be,
sure
could be.
people
I do see,
understand.
by the way, recently a lot of C-level executives selling, and
Yeah,
the thing is, it's their shares, so it's
they
difficult
can
to
do whatever they want
criticize
with it.
them,
Yeah,
right? It's their shares, and there are a lot of reasons why somebody might sell. I mean, maybe they need to buy a bigger house. I mean, it's personal, right?
the
So
the, the thing when you see insider buying and insider selling, when an insider sells, I don't really know why they're selling. Uh, they might be selling because they think the company's going to struggle in the future. They might be selling because they owe a lot of money on their mortgage, or they might have a medical emergency. I don't know. Nobody knows except them and maybe
yeah,
their close circle. But so you could just keep guessing why this person's selling. But when you see insider buying, you kind of it's you know why they're buying. They think the stock price will go up. People don't buy because they think it's going to go down. So it's very clear when people buy. We know the reason, but we never know the reason why they're selling. It's just
yeah,
speculation.
I agree. And in general, I think all the research that is out there when it comes to insider selling, there is no proof that there is a certain price movement after the action to sell. So just because there are way too many reasons.
Yeah, yeah. It's just, but it doesn't look good, and I get it why people like say, "Oh my God, there's so much insider selling. I don't want to buy the stock." Because, but VinFast Auto, pretty big company, 70 billion market cap.
Vinfast. I have not heard of this, to be honest. Maybe is it a
Yeah, I'm not
Vinfast
familiar with it.
auto?
I always like to just
But it's a relatively new in terms of being a public company. I see.
it's a sing
So
it's a looks like it's a Vietnamese, well, headquarters is Singapore, but their executive offices are Vietnam. So this is like a Vietnamese EV company. Um,
EV in what form do they manufacture in EVs, or is it related some equipment related to that or some?
just in 2017, so it's really new company, is the first Vietnamese car brand to expand to global markets into producing EV cars, EV scooters. Hot market. EVs are really, and everybody's trying to look for the next Tesla. Is this the next Tesla? I always get a little weary for non-US companies, especially certain countries, because nothing wrong with any country, because you can live in any country and build a business, but the risk is there's always their stock prices generally drag down a bit. It's like if you buy a stock in a Brazilian company that has the same revenue, the same profits as a company in the U.S., same type of company, very similar numbers. The U.S.
Yep.
company would have a much higher market cap than a Brazilian. There's that country risk premium. So that's you have to consider that also.
Sure. And that
Uh,
is fair. I think that is fair.
um,
Right.
but that's not a reason not to buy a company in another country. Just something to consider. Um, let's look at a chart. I'm curious how
I think it's recently public. I don't think there's a lot of
it's real recent. Yeah, wow. That's why I don't know much about this because it's
I
only
mean,
August
maybe
13th IPO'd.
maybe to those who are following this stream, every time that I see a company of this kind, and there's always the same kind of focus on revenue and how much it's growing. And I think there needs to be another approach to it. So, for example, if it is a company that aims to produce EVs, right? They need to have the capacity to do that. So the question for me would be, well, what do they have? What are the assets that they already have in place? How much do they need to invest in the future to get to a certain level? So to manufacture 100,000, 1 million, 2 million, I don't know how far they're going to grow. But also keep in mind that, for example, annually there are about 60 million cars being sold, manufactured and sold, 60 million. So if you assume that this particular company, and it doesn't matter which one it is going to get to 5 million, that is already quite a significant portion of the total. And that's quite difficult to actually reach. I think that the top ones have probably like 11, 12% market share. So if you automatically, if you assume that any company will produce 5, 6, 7 million cars a year, then you're basically assuming that that company will be the number one in the world. So projecting the numbers is fine, but try to also convert that into more tangible topics such as manufacturing of the cars, or I don't know if it could be scooters or whatever that may be related to VinFast. But also, then the question is, do they have the capital to get there? Do they need to borrow? What are the chances that they'll be successful, right? Because it's not only about having the capital. Is there going to be enough demand for their products and so on? So I think any company really takes a lot of time to dive into the numbers, but also to try to understand the products, and kind of paint a big picture around it to understand which way it's going and what it takes to get there. So otherwise, if we're trying to look into VinFast and come up with a conclusion in 5 minutes, yeah, it's not really going to be. So James, that's a great point that you're making. VinFast is building a new factory in the US at the moment. Great.
it.
So for example, what I would tie this for is, when is it expected that this company completes? What is the capacity? So for example, if it's expected that it's completed in 2025, then you know that more or less 2025 will be the year when you see revenues coming from that particular factory. Then if you know the capacity, you can try to estimate the revenue that this particular factory will be generating. You can use maybe some comparables when it comes to, um, for example, gross margins, right? The operating expenses, more or less, you can estimate again based on comparables. But the difficult part is when it comes to the demand. So, Buldek, you mentioned the reviews are terrible for these vehicles. I mean, could be. I'm not familiar with this company. That's why I don't really have an opinion to share, but I like to at least share my thought process, how I would go if I'm to research this company. So if you think that this company will not have sufficient demand to meet its capacity, so if, for example, they have the capacity to produce 50,000, but they're able to sell 20,000, well, that's yeah, the margins will be significantly different. Um, Lordstown Motors.
Yeah,
I'm not familiar with these two. I have I've not heard of this company yet, so I'll quickly look into it. Lordstown Motors. Um,
that's a popular one. That's been on one of those meme stocks. I feel. But you said it's a SPAC. I didn't.
what do you mean, by the way, it doesn't apply? What is the part that doesn't apply to it? It's difficult to.
What's that?
I'm trying to understand what Bulldog means. Sorry, what Bulldog means when he says it doesn't apply. For instance, Lordstown Motors. So by the way, I don't know if it's expensive or cheap. I have not looked into it, and that's why I say, if I want to if I'm to share my thoughts on the company itself and the valuation, it would take really a lot of time.
Yeah, I mean, I think we're just trying to like when I hear about a company, especially a company I'm not too familiar with, I just first like to list make sure I understand exactly what they do, or at least close what they do. So yeah, EV car manufacturer in Vietnam. So that gives me a good amount of information. But what Costa's saying is something you definitely need to do, but it's going to take a few hours. But something, but I think they had 15 trillion Vietnam dongs of revenue. I hope I'm saying that right. So $600 million US of revenue in 2022, which is I mean, the market cap, what is it, 50 billion?
Yeah, this is what I mean. It's really difficult to use the historical numbers. If they have, for example, one manufacturing plant that will start manufacturing as of, for example, a month from now, and they have another one that will start manufacturing products or cars in this case in 5 months, obviously the revenue will be significantly higher than they are at the moment. It's
70
really
billion.
difficult to judge based on the historical numbers.
Yeah, you can't. I mean, but obviously, yeah. With a lot of these companies these days, especially SPACs, it's more about trying to predict the future. I have one rule, a couple of rules in life. Don't have sex with a prostitute, and don't invest in SPACs. I mean, I'm a simple man, but those are kind of my two rules in life. So I think staying away from SPACs, you could probably save a lot of money. I do see the appeal, and they're legit companies that get acquired by a SPAC. They're not like scam companies, although 90% of them have gone down over 90% in value within the first 2 years. So it's kind of like it's so risky. I mean, it does seem interesting. Yeah,
Sure,
price sales
car
126.
companies are very difficult to especially if you start from scratch to build one and then to have it profitable. I mean, there are very few that have been
Yeah,
profitable for a very long period of time. So, and Tesla is at the moment definitely the outlier. If you
the
take a look at the
margins
other
are
ones that started,
yeah, the margins are just so low. It's very expensive to build, manufacture cars, the infrastructure, the marketing. I mean, there's a lot of competition. It's like if you look when like GM and Ford when they in the beginning years, like there was like so many car companies, dozens and dozens of car companies trying to get a piece of the market, and really only like 3 of them survived from Bulldog. Thank you, very nice, appreciate the donation. Yeah, it just so few survived, but it's just like anything. It's just like in the late 90s, early 2000s, all those .com companies, probably thousands of .com companies, but how many survived? How many are still alive today? Just a handful. It's if you could find the right one and sit on that investment for 2 to 3 decades, you could be, but it's so hard. Yeah. What were you say?
yeah, I agree. I agree. It will be comparable now with the AI boom. I mean, there are a lot of companies that are rising, and some will do incredibly well, and some will not do so well, and that's
Yeah.
quite normal. There will be a lot of losers, and then there will be really big winners. And maybe we've seen some of the winners already, but I mean, I think we're relatively at the beginning when it comes to the AI. So it's definitely interesting time.
Yeah. Yeah. Lordstown. So they have no revenue, and they have the same market cap as this Vietnamese company. Oh no, what am I saying? 64 million. The company's 64 billion or 60 billion. Yeah, Lordstown. That's the thing. Like, um, a company with no revenue, it doesn't mean they're gonna have no revenue forever. It just makes it me a lot more nervous. It's kind of like if your friend said, "Can you invest $10,000 into my business?" and you said to your friend, "Well, can you tell me like what you do, what your revenue is?" And if your friend said, "We haven't sold anything yet," you probably your comfort level will go down. You would need to hear a lot of good points to invest money. But if your friend said, "I already have 50,000 sales, I have a million purchase orders," you'd probably feel a lot more comfortable. So I just get a little weary.
Sure.
Companies with no revenue. It's so much easier just to find a company with companies that've been around decades. You'll see like a company like Walmart or Disney, their stock price could go down like 50, 60%. And they already have 10, 20, 50 billion of revenue. You could find companies that are trading at a really low price and they have a ton of revenue. You don't have to try to like be bottom feeders. Yeah, AOL. Sheesh, that was what a great company though. Remember those AOL days? Do you remember it? Well, you're too young probably for AOL, right?
I'm too young. I only remember them as a sponsor to some football clubs, but for the rest, not that much.
Yeah, those were the good old days. I remember when AOL came out. It was so much fun because it was nothing like it. Like you could talk to people in other countries.
Uh, I think that Scott has some connection issues, so hopefully he'll be back soon. Ah, there he is.
You,
Scott, we lost you for a minute there.
you did? Oh, I
Yeah,
didn't. I didn't see
now
it.
it looks good now.
Nothing changed on my part. You've got mail. Oh, that was what a great feeling when you get that. You've got
Yeah,
mail. Um, but yeah, I'm still trying to figure out this investing thing. I feel like I'm always relearning things, and like I think I understand it, and then I realize how little I understand. But
that's
what,
good.
what do you what Costa? What are your? I think people want to know like what. I mean, you don't have to tell us what you're invested in unless you want to. Or what companies do you like and or don't like?
Sure. Well, I do share my portfolio publicly every month. So there's going to be every month a monthly update of what I've changed within the portfolio. Um, I I'm quite a boring person in that regard. I'm not chasing for the meme stocks. I'm not chasing for the super high growth stocks. I'm trying to be diversified. Currently, there are 15 positions in the portfolio. I hope to have it higher. Maybe 15 is too low at the moment. Maybe it'll get to 20, 25, 30. But I want to make sure that those are companies that I really companies that I understand. Um,
So do you invest in ETFs or mainly just single
no, just
company?
just individual stocks. I'll quickly open the portfolio, at least the most recent one. And I'll share, of course, a couple of thoughts around that. I don't mind that. So let me take a look at it as of August. US. Well, I mean, I have Google, part of the portfolio up 40% since I invested. I have Amazon. I have a bit of Floor and Decor, a bit of Intel. These are all positions that did quite
What,
well so
what was
far.
the third
I
one you
think the
said?
one that, sorry,
Florum? What was the third
Floor and
one?
Decor, Floor and
Oh,
Decor.
Florida Core.
Yeah, and I think the one that did incredibly well last month was Upwork. So it was just a lucky pick. It went up close to 50% in a very short period of time. And Zillow as well. So I have Zillow, quite nice return there as well. I also have, these are really the relatively large ones. I have a lot of companies that probably most have not heard of. I have HelloFresh, a European company. I think in the
Well,
US there's
what,
Factor.
yeah, I think people know about HelloFresh in America.
Yeah.
Um,
Then I have certain companies that are really small cap, like under 100 million, such as Jerash Holdings, and I have Recently, I added a new one. It's called Leroy Seafood. That is in the seafood kind of industry with fish farming. Yeah, Zillow is the one that is one of the smallest positions. So it's, I don't know. I can quickly calculate the percentage. 239. It's like 2% or so of the portfolio. I'm up almost 60% on it, by the way. So I'm quite happy with
Wow.
that decision to get it. But it's, to be honest, Zillow has been one that made a very bad decision to make this decision to flip homes that turned out to be quite bad. And eventually, when they decided to reverse that decision, that basically they admitted that they made a mistake. Actually, they did. I think that the remaining part of the business is quite well. I saw that recently they announced that there will be some
Yeah.
1% down payment of some sort, so it will be quite a difficult one. So I'll keep it, but it's I don't have really a lot of exposure there.
Yeah.
But these
I
are,
mean,
some of the companies.
yeah, flipping homes is so is a really challenging thing to do on a large scale, and companies have been
I
trying to
agree.
do it for a long, long time, but it's
I agree.
it,
I agree. And
on,
even
on a small scale. A lot of things like it's very. I want to say it's very easy to do something, but it's so much easier to do something once. Like it's so much easier to build a car once or to flip a home once, and it's and to make money doing it, it's or to do it well, to do things once is a million times easier than to do that than to make that same car millions and millions of times the
sure.
same way. Like
I mean, if you
mass
think about it,
producing is very hard.
theoretically, if anybody could do it, it should be them because they have the most data, right?
It
Um,
should be.
it should
It's
be, but
just
it's not easy, and
it's
also
so hard.
the market could significantly change. It has been an incredible bull market when it comes to the real estate prices. That can significantly shift, and I think even at the moment the prices compare. If you also combine that to the high mortgage rates, I mean, it makes it really impossible for a lot of people to buy homes now. So that's not sustainable, right?
Right. Yeah. It's and I think like the real estate market, I was a real estate agent just for like a year or two when I lived in Staten Island, just for fun, really, to learn. I've done a lot of things without like just for fun, just to learn about it, like for my own. And it's such a specialized thing, real estate. It's kind of like people generally like know a realtor or personally, or if they don't know a realtor personally, so one of their friends or family members knows a realtor. So it's such a specialized thing. It's hard to do things on a mass scale. Um, like you can sell coffee on a mass scale. Starbucks does it really well, but I think like real estate, it's such a, like a community based thing, and people trust. They trust people they know. They don't like. I mean, you don't need to trust a person making coffee. It's not like the end of the world. It's not that big of an investment, but for a home, like it's really important you trust, and you the person you're buying it from or the person you're listening to is someone you know or know through somebody. It's so important.
Sure.
Um,
Sure. But also, if you think about flipping homes, first of all, you incur quite some cost in the form of transactions.
oh,
So,
that's a
and
different
and you
animal
also
altogether.
have a
Exactly.
very low margin to start with. So your starting point is, if everything goes well, maybe you make 10-15%. But then if you deduct taxes, and then if it doesn't go well, then yeah, I mean, all the operating expenses, you might end up losing money, which is actually the what the experiment of Zillow showed.
Yeah, it's there's so yeah it you lever up so much, um and it's kind of like I don't know if anybody's uh that like Dave Ramsey, this happened to him. A lot of people like they buy real estate, like they'll start with, maybe they live in a condo, they buy a condo for $200,000 and they live in it, and they're like, I'll just rent it out, move back home, and then they buy another condo and then rent it, and they keep doing that over and over and over and over, and it works out great. And you lever up because most people don't have, even if it's $200,000 condo, most people can't buy 30 of them. Maybe you can put down 10% on 30 of them and take a mortgage on the rest. But once something happens, like rates go up a lot, or like a few of your tenants don't pay, or something happens, your
Yeah.
spouse is having medical problems, they can't, you then it's like falls like a house of cards.
Sure.
It's kind of like using leverage in the stock market. Like it sounds great when market's going up and it works out well, but one thing happens and just everything falls apart.
Yeah. And there's always, I mean, again, we go to the point that there is always risk, regardless of the decision made, there's always risk. Even
Oh
if you
yeah,
own
of
a home,
course.
once in a while there will be a large expense to fix something, whether that's
Yeah,
some
like I
part of
had
the
a
wall
50
or a roof
grand
or whatever.
for my.
I think we're losing Scott again. Let's see how long it would take to get him back on.
But
Scott, you need to pay your internet bill, my friend. We
what's
keep
that
losing you.
again?
Yeah, now you're back. Now you're, yeah. The last thing that I mentioned was that it doesn't matter, even if you own a home. Eventually, you'll have to pay a big bill for certain renovation.
Yeah, and the taxes in my so expensive. It's like the taxes is like if I wanted to get a 1-bedroom apartment, like if I was single, it would be about the same amount for my rent, the taxes I pay each month. It's so expensive.
Well,
I have a really
it is
good.
what it is. That's life, right? You have to pay taxes as well.
Yeah, it's well, depending on where you live, like certain places it's so expensive. But yeah, I mean, some things you just won't get away from, even if you have pay off your house and
Yeah.
pay off your credit cards. Like your roof caves in. You need a new car. Things like
Yep.
you have to be prepared. But so
I think it would be nice to have a bit more, maybe insights into kind of more financial literacy somewhere in high school. I think that's a bit missing in the world. Um, Everybody's being thrown in the world of having to have a job and work and all the options of getting credit card debts and all that stuff without really understanding the outcome of all these decisions. And maybe that is something that should change, and it would definitely make, at least should help the ones that want to make better financial decisions, whether that's about renting or buying a house, whether that's about how to make a budget. Even these are kind of topics that I think they would be really beneficial to the coming generations.
yeah, that's true. They don't have anything in high school. Even my undergrad, I didn't think I learned much. Even I mean, I got my MBA. I don't really. Maybe it's me. I probably didn't study or pay attention.
No, I
But
mean,
I really don't think I learned that much.
I don't think that the courses in general, regardless of the university, are structured in a way for personal finance. It's more, if it's accounting, then it's just understanding the language.
It's
But
theoretical.
it's
It's
not
not.
so much the
Yeah.
outcome of what is the outcome of certain decisions. So there is some room for that to, I mean, I'll probably make a video or kind of a short course on that. I think it should be helpful.
Yeah. I'm trying to get into college. I try to get into colleges to teach courses on like the stock market or valuation, but it's impossible. I've taught. I started teaching these classes just to elementary school kids. I did like a dozen of them, like a stock market class, interest rate class, a real estate class, and I have them do like a game to try to understand how this stuff works. But it's hard to
I don't know.
get something.
Do you think maybe elementary school is a bit too early? Because I'm just trying to, if I go back
Yeah,
in time.
it is too early. I thought middle school would be ideal. It's just that because I had a business where I taught math to mainly elementary school kids and some middle school kids, and it just seemed like the high school kids never wanted to do this extra math work because they'd rather spend time with their friends. It was so much easier with the elementary school kids. They were happy, whatever I asked them to do, they generally did. The older they get, the more difficult they are to. They're not as receptive.
Right. Then it's just the teenage years, then probably, right?
Yeah, I mean, there are always going to be some that are receptive and interested, but
Sure.
but a majority generally they're kind of too cool, and it's just yeah. I was looking to start a business, like an after school, to teach kids about like finance or business or real life, but I don't know. I put that on the side. I didn't. I thought it'd be too difficult.
I mean, if you think about it, you have a platform such as YouTube, you can do that here on a larger scale, right? If you
Yeah,
think about it, if you have a class of 3 or 4 or 5 or 10 children, well, here you could have a much wider audience and you spend pretty much the same time, right? I mean, it would take you maybe more time to prepare the video and record it, but then you can reach more people. So ultimately, it all
yeah.
comes down to figure out a way to, yeah.
Too
It's
bad.
it's not an easy task, by the way, of course.
It's not. I'm just so. I think boring. Uh, I don't think it's as. Some people do it really well. Some YouTubers have a really good kind of personality, and they keep people tuned in. Um, I don't really have much success with that. Um, I mean, it's okay. I mean, my viewership is okay, but it's not nearly to the point where I can actually make a living on it. But I've
Yeah.
accepted that, and now I play poker. Um,
Yeah, but well, look, by the way, I agree that the traders and investors on their own do not add much value in a way. But I wouldn't fully say that there is nothing being created. The way I look at it is more I mean, the traders, it's a different case. But for the investors, I would say, especially for example, if you're investing in a startup that might fail, basically you're the one in a way helping that startup even get a chance. So I wouldn't fully say that investors don't
yeah,
add much value.
I
Um,
think. Yeah, I know his point. Investors add an extreme amount of value because without investors, we wouldn't have companies like Microsoft, Apple, all these major companies. We'd have them on a smaller scale. But I think what he means is maybe more the secondary
yeah,
market trading and
I agree. I agree. I agree. That's why I mean I want to make a distinction between the traders and investors that are on the on the public market, and then although even that is even that is required for certain companies to be higher valued, so they can raise further cash and continue expanding. So I don't really agree that there is no added value. I think there is some, but of course it's not the same as if you compare engineering and computer science and certain real industries that actually do the real work. So there is a difference, but I think everything there is a little bit of everything required in the world. So I think if I go back in time, one thing I was passionate about was computer science. I did learn one programming language a bit, that is Python. I have used it many times, also when it comes to finance, and it has a lot of value. So I think there's always a room to kind of connect multiple of these fields into one and create value that way. So imagine if you have somebody who has the knowledge of accounting and is also an engineer. It would be much easier for that person to raise funds to communicate to others. Or if you have somebody that's in computer science and also engineering, well, that's already a bit of a completely different skill set that puts that person above the others who have only one. So
yeah.
I think people should not be. In general, people would be better off if they try to identify as more than one profession. So if you're just in finance, great, but what else? Because otherwise, you're competing with a lot of people that do exactly the same or something comparable. And having this a little bit differentiation can really make a big difference in life.
Oh, I didn't mean to do that. Okay. Um, yeah, I think. Yeah, I know what he's trying to convey. The way I look at it is like I think everybody as long as you're not hurting somebody, as long as you're not like, going out to rob somebody or murder somebody, as long as you're not, you're doing something of, I mean, you could do it. You could sit home and like me and play poker for hours online. You can make YouTube videos. You can go out and work at Starbucks. As long as you're doing something that's not hurting someone, I don't see a problem with it. Um, I don't like people who are angling to kind of, yeah, I don't mind people who are trying to like make money as long as they do it, I guess, somewhat ethically. Um, but so everybody has their own angle. Not everybody can start a business and employ people. I think those are the real heroes, the people who can start a business, employ people. But there's nothing wrong with working at a company, and
I
you know,
agree. I agree.
there's
And there's always, by the way, being part of a large company, having good managers, it's incredibly important, especially if
yeah,
you're young.
yeah,
For those that are young, I mean, that is the thing to do. I've spent the first decade working with amazing managers, and I mean, if that was not the case, I think the level of knowledge would not be where it is at the moment. And I think anybody who doesn't have a manager that kind of elevates you as a person, then try to find an environment that helps you grow, because ultimately it really really makes a big difference.
yeah, yeah. Success breeds success. Um, you also be doing something to
James,
benefit the
I
world.
shared my portfolio actually today as of the end of August. So I do it um, once a month. So for example, at the end of September, I'll do that probably beginning of October, 1st or 2nd of October. So I do that every time, the first or second or third day of the next month. I do have Disney, by the way, a very small portion of the portfolio as well.
I just bought
So
Disney a week ago. Um, I hope it doesn't kill me like Intel. I bought Intel and lost 50% on that.
And by the way, Bulldog, I agree. It's definitely making filling your time with things that you enjoy. That's the most important thing. Otherwise, you're just pretty much wasting your time. And my hobby is basically just making videos, and I do that for free. I don't charge anyone anything. I don't have any promotions. So that is kind of my non-for-profit part of life that I enjoy doing, and I want just enjoy contributing. I see that, Scott. You have my video on screen. You can skip to the portfolio. That's the portfolio part,
That's a
and then
portfolio, right?
yep.
Um,
So the green, I have marked the changes throughout the month of August, and I have later on the performance versus the market, and I have a small segment on Leroy Seafood, which is the new position, because it's kind of a special case that, I mean, at least it got my attention probably
so the
almost a year
current
ago.
value. Okay, so the current value is right here. Um,
Yes,
and the
that is
cost.
the current value, and there's the initial value, the transaction, and I include the transaction cost as well, because I think that should be part of the cost.
Disney is at like 20. It's back to 2014 levels, I think. It's like at a 9 or
Yeah.
10-year
Yes.
low. I mean, it
Yeah, and they're
probably
going
got.
through some tough times.
It's just so. It's just so hard to not to imagine that Disney. I mean, such a powerful brand. I thought that'd have been Intel too, but I don't know.
Yeah, I mean, it's one thing to have brand, but ultimately you need to deliver cash flows, right? And Disney has been struggling with that. On one side, they have their old school cable business that is not going to do well because there's a lot of streaming out there, and then they also have the streaming business where they pour a lot of cash, and it's not that's not the extremely profitable part yet. So they need to figure out how to do that.
Oh, you have Intel also. You're up on Intel, huh?
Yeah, but I have a very small position on Intel because I mean I do see some risk. I don't think they're the market leader for the years to come. So, but also I don't think that they're going to be the worst performing company as well. So, I have quite some exposure in different companies. The ones that I think are provide a better risk return opportunity. They have a higher percentage allocated to them, and basically, by the way, the idea behind this portfolio was I'm going to deposit funds every month, and I'm going to figure out where to invest it if I have a good
Mhm.
opportunity. If not, it will remain as cash. And the goal is to look into this every month, but also imagine if I can look back to this in 10 years' time. So it would be just a fun exercise that I do in public. So everybody can look into it, can criticize the positions, can provide suggestions. But ultimately, when it comes to the investment decisions, those will be solely mine. And I think it will be interesting also to see how the portfolio will perform against the market. So at the moment, it's doing quite well, but it's a very short period. It's this is the you see the episode 11, so it's pretty much the 11th month, not even a year. So there's still a lot of time ahead to see whether I can beat the market through this portfolio or not. And the chances are not in my favor, by the way. The beating the market is not an easy task.
No, yeah, not many people do it. Hardly anybody does it. Um, looks pretty solid.
I don't have any long or short. I don't use any hedges. I just use long in the portfolio, so I just go long. And my time frame is, I have 20, 30, 40 years ahead of me to invest. So I'm quite okay if certain companies go down, even if it's 20, 30, 40%. But if I do feel that there's a bit more risk, I might just reduce the positions in some and keep the excess amount in cash. So I'm not going to short the market, but I'm going to diversify even further. For example, one of the companies that you see here, the third one on the list, is Cakebox. Like, that's
Mm,
not a company that many people know of. It's an incredibly
no.
tiny company in UK that sells cakes. I mean, it's incredibly boring company, right? I mean, who would like to buy a company that just sell cakes? And not just cakes, it's a vegan cake, so it's even more niche. But I'm happy with that. The portfolio, like you see, the position is up quite well, and it also pays for like 8% dividend yield on my cost. So I'm quite happy with that. I'm not searching for the next big thing, so you won't see any GameStop or AMC in the portfolio, and I really do a lot of work before I decide to open a position. So for example, Leroy Seafood, I think that's an interesting one, um, because that is a Norwegian company that the share price went down quite a lot because there is a new tax related to salmon farming at 25%. So these companies that are involved in this industry would pay 25% corporate tax on top of the 22% that they already pay. So we're looking at, and of course, it's not just salmon that they have other sectors, but these companies will now suddenly pay 40%, for example, taxes. It's a significant increase. And I saw that the market reacted rightfully so. The share price went down a lot. I think when it comes to Leroy, it overreacted a bit. So it's a small position in the portfolio now. So we'll see how that goes. It's not a dividend portfolio. It has a bit of both because it has some companies that pay dividends, and I was just lucky to buy some at the really really good timing. That I mean, luck plays a big role in the portfolio for sure.
So
But yeah, I mean Disney. If you take a look at Disney, the old school CEO is back. So that's something that yeah, he managed to build Disney to the company that it was. So I mean, I'm quite comfortable that he will make big changes, radical changes that are needed in these times. I don't know if it will reflect in the share price in the next year or two or five, but I'm open to having a little bit of exposure to Disney. And but yeah, I mean that whole woke thing is just I agree, it's a bit too much.
yeah, I didn't write down my cost basis for Disney, but I'm definitely down because I just bought it last week and it's down. It keeps going down, but I mean you can't. It's hard to catch the very bottom of anything. I mean,
And
you just
and
gotta.
I'm not aiming. By the way, Scott, I'm not aiming to. What you can do is if you take the Amazon share price. I mean, it's of course an extreme example. If you bought 1 month later or earlier in the 2000s or 2001 or 2002, it doesn't matter. You would have still done incredibly well, right?
Yeah.
So it's I'm not really someone who tries to time the market. What I do is I do my homework. I try to value the company, and then when I'm comfortable to open a position, I do it. And if it's, sometimes it will be at the right bottom, sometimes it won't be. But most of the times it won't be, and that's okay. I mean, if it's as long as it's in the right direction.
Right.
What
Victor has a good
sectors?
question. This is something like I go back and forth on. I think the best companies. Well, it's hard to say. I think companies that um, make something make a physical product that's really needed, like a company like Kraft Heinz, like the products they make, I think are just of course there's competition, but like it's always going to be around. We're always going to need like tomato sauce, pasta, whatever, paper towels, like those kind of things. When you look at a company like Palantir, um, like some other tech companies that you're not even sure what they make. So I think companies that make like consumer household products, uh, with companies with like that do that with a solid balance sheet, have been around a while. I think those are like the more safest, um, long term. But like I said, I go back and forth. Like at one point, I'm like, tech. It's got to be tech because tech's the future. Then I'm like, oh, tech's too risky. Then I go banks. Got it. Banks are safe. Then I'm like, no. So I think consumer staple products are some of the safest sectors to invest in. What do you think, Costa?
I'll approach this question a bit differently. I think within every sector, within there's a good company to invest in
Yeah.
at some time. And it's difficult for me to answer the question because it's also very personal. It If somebody's stock picking, you need to find what you're knowledgeable about. So if that's banks, and you can really understand a bank to really understand the value, then maybe you can extract value from that. If you're really good at estimating the value of consumer staples in certain markets, then you might be able to find good stocks there, good companies to pick. But I would not point to one sector because, for example, if you take a look at tech, if you're looking at a company that is involved a lot in AI, like artificial intelligence, but you have no idea what it is, how it operates. You have no idea about the competitors. Basically, you are making a blind guess of what the company would do in the next years because you just don't understand the business. So this is, for example, why I avoid companies in the biotech industry. I'm not that familiar with the whole drug research process. I don't know which company does what and how likely it is that that drug succeeds. I cannot estimate really the impact of that drug on the market, so I just stay away from it. So maybe it's a bit of a different approach. I'm trying to identify what I should not go after because I don't understand, and then from what I do understand, I try to find good companies within. Personally, I think that um, there's more opportunity in smaller companies like mid cap and small cap companies compared to the large cap companies because everybody's looking at the large cap companies, and the
Mhm.
volatility is just different. There are different players. If you take a look at the small cap companies, I mean, that's where I think the real opportunity is for retail investors. The thing is that there's not a lot of exposure there, so if somebody wants to find a good opportunity there, they need to do the research themselves. They cannot rely on anybody on, and I don't think people should rely on anybody on YouTube or Twitter or Reddit. If you put your money into something, you need to do the research yourself. And I find it ridiculous that many are willing to invest because they read someone saying that this company will do well. But on the other side, if they buy anything else, they're going to do a lot of research. I mean, I know people who would, in order to buy a TV, that they'll take a look into a couple of stores, they would take a look at the models, take a look at the specifications, and then the next day they would put more money into a company that they don't know much about, and they just read a post somewhere. I mean, it's just not the wisest decision. And then a couple of days later, then there's a question, well, what should I do? I cannot answer that question. So
Right. Right.
this is why I think it's a bit of a different approach to this particular question. I don't think there's any sector that's always good. I don't think there's any sector that's never good. There's just different sectors, and you need to find what you're comfortable with, and then find the right the
Yeah,
right
if
pick for
you're
you.
willing to do the work, there's definitely every sector you could find good values, in every sector you could find bad values. It's it's hard though because a lot of people don't know what to look for. It does take a long time. I'm still trying to figure it out. I think there's days I'm like, oh, I get it, I understand everything, and then I'm like, I don't understand it. I thought I understood it. Now I feel like an idiot. But you just got to kind of like have a what is it, Scott could be reported to the SEC for saying expert analysis with the video being evidence that he knows nothing about security due diligence. Okay, interesting, Ben. I guess, yeah, the SEC could come after me. My sector, what sectors have been down and maybe coming back?
I think there are a couple of websites out there that you can check, Victor, that kind of show the performance of each sector over the last, I think, for example, 1 year, 3 years, 5 years. But the thing is that historical data isn't really an indicator that there will be a reversal. So, for example, if you think, okay, energy is the one that is coming back, sure, but it is also one that is most exposed to geopolitical risks. If you think about what happened in, for example, other parts of the world, if there's anything else happening there, there are a lot of players that can impact the energy prices one way or the other. So I'm not saying that it's not a sector worth investing in. Every sector is, but you need to find the right company within it. It's difficult to answer what may be coming later. I'll give you an example. We have had a period with high inflation. It has impacted a lot of businesses, and you could find businesses that have been harmed by inflation that will be recovering in the next period, assuming that inflation will remain under control, which is not a guarantee, right? So every business has certain risks. I think that ultimately, if you have a long-term vision, if you have the goal to hold companies for a long period of time, then maybe it makes more sense to think of, is this company going to do well in 10 years time? So not, is it going to do well next year or in 2 years, because that's a relatively short time frame. And I've been part of a public company. I am part of a public company. I've spoken with a lot of executives in other public companies. The reality is that there's very few that know what will happen more than 2 years from now. So even though they have a vision for the future, they just focus on executing what's ahead of them. So for the next month, what do we need to accomplish to keep staying on the right track? So
Yeah.
it is really like the CEOs don't know what is ahead of them, and they don't know if the sector is bouncing back or not. They have the data, that's the real time, or maybe a couple lagging by a week or a month, but that on its own is not sufficient to really make a claim this industry is coming back or this sector will benefit. It's difficult to make that kind of a high level analysis, and there are really good macroeconomists that can make some predictions, but then there's the second challenge. Even if you know which sector is going up, then the question is which company within that sector will do well. That is a further challenge, then, which means you need to do a lot of further analysis.
Yeah. I mean, there's really no way around it, and things move quickly. Like, that's a funny thing. Like certain stocks. Stop it. I'm trying to actually learn some credible information. Kostadin. Okay, sorry, man.
Yeah, I'm not sure that I did not feel that Scott interrupted me. So please, if you have questions, drop them in the comment. I think you're a bit maybe behind in the video, so I'll just add a comment.
No, I think he's just trying to like troll. No, he's just trying to troll. Like he's trying to
I mean,
trying
it
to
doesn't matter.
needle me, I guess.
Sure.
But you don't have to mute. But anyways, but yeah, things move fast. Like you start, you're really bullish on a stock or bearish on a stock, and before you know it, there's a 20-30% swing. So that's why there's really buying and holding is the only strategy I have figured out. Like not trying to time it, kind of like what Warren Buffett says, his time frame is forever. Like he's not looking for he's generally not in it for a 1 year time frame. Like when I buy, it's generally forever. Of course, I sell stock because I start to lose faith in the company. My analysis changes, but it's there's really timing it is almost impossible. Long term view is the only way to go. Let me know the questions that you have. But yeah, Costa. I don't think he's being serious, Ben. I wouldn't. I think he's trying to like.
That is fine. That is fine.
I
I
don't
mean,
know.
I would like to give the opportunity. So if he has questions, I'm happy to help. If not, that's also fine. But I mean, I try to take it seriously, whether that is the case or not. There's no harm in that, right?
Yeah, yeah. But okay. So it's been an hour and a half. So I think it was a good stream. I think we got a lot out. Um, if anybody has any specific questions, I guess we'll end it unless anybody has anything else they want to throw in.
Oh,
I just don't like to promote gambling.
yeah, Ben, I understand that, and I agree with you on that. I think that gambling is not the. Um,
I didn't
I
think I was
personally
promoting it,
don't
but
engage in that. I know a lot of people whose lives have been destroyed by doing that. I'm not engaging in those activities, and I do agree with you that it can be harmful for many. So I please do not take any of the conversation as promotion to gambling in a way. Um,
but
Victor,
are
your
you
question. Sorry, go ahead.
Ben? Do you mean because I brought up poker earlier? Are you referring to that comment about playing
Yeah,
poker, or are you referring to gambling on stocks, like
I think it's the
the poker
poker
thing?
part. Yes,
Okay, I
I think
mean,
so.
I didn't really. I brought it up for 10 seconds and to let people know why I'm not making as many videos. But I didn't
No,
mean to promote it.
I understand. I understand. It's still. I understand his point. That maybe some of the viewers would be more, caught attention from that discussion and just kind of move towards that. But in any
Yes.
case, Ben, it's a fair point. It's a fair point. Victor, is it better to own a few stocks or diversify into more stocks? I think this is a very personal question. Uh, it depends how comfortable you are holding uh, many stocks compared to few stocks. Personally, I always diversify. I think that it gives me better chances of being right and also being wrong as well. But if I'm right 6 or 7 out of 10, it just gives me better chances as opposed to if I own two stocks and I'm wrong on both. I think that Personally, I think that those who own a very few stocks are a bit arrogant. They believe that they know something more than the average investor out there. I certainly don't know. But on the other side, if you think about um, what is the right decision, it needs to come from yourself. So if you own, for example, only one company, just imagine that that is the case, and you go to sleep, and the next day, or 2 days later, or 3 days later, the company is down 30%. Would you be still well? Would you feel well? Would you be worried? If the answer is no, if you say, "Oh, look, I trust this company, it will do well in 10 years' time," and you can continue sleeping well, then maybe that is a strategy that will work for you. But if you're on the other side, somebody who's more risk averse, who would like to, be on the safe side, the complete opposite part is being diversified even through the index, right? So there's a wide spectrum, and you need to find where you fall on on that spectrum. So personally,
Yeah.
for me, I try to be more diversified. I don't mind having 15 companies and 20 and 30 if that needs to be the case. But I want to make sure that for every company within the portfolio, I have done my homework, and I know that the chances are with me that it will do well over the next 5-10 years, not over the next month or a year. I don't know what that will do. Any company will do over such a short period of time. And by the way, anybody who says that they know what will happen in the next 3, 6 months, a year, I mean, they're just guessing. Nobody can do
Yeah.
that. Even if you take 2, 3 years, I mean, even that is a relatively short time frame for anybody to predict. So this is also, by the way, a lot of analysts, actually a lot of advisors even have a rule that if your time frame is shorter than I think 5 years, then even stocks are not for you, because even 5 years is a very short period um, to have a
Right.
positive return on stocks. There's a chance that the stocks will, even if you use the S&P for example.
Yeah, it's no, it's impossible, yeah, to predict the future. And if you do, we all get lucky. I've gotten lucky. I bought a stock. I remember when Bear Stearns filed bankruptcy in 2009, or was it 2008? When I filed bankruptcy, the stock was down to like $3. No, it was like $1, I think. Yeah, I think it was down to like $1, and I bought like 1,000 shares, and then they got acquired by J.P. Morgan for like $5 a week later. I mean, I knew it was a bit of a gamble because they filed bankruptcy, but I just had a feeling Bear Stearns can't go bankrupt. Like something's going to happen, and it did. But I mean, I could say I'm a genius. I knew it, but like, there's plenty of times I've done that and it didn't work out. So,
Yeah,
um,
it's sometimes luck plays in a role for sure.
yeah. Um, but there were times when I was super focused on one or two stocks. But as I got older, I am diversifying more. Um, but I don't see a problem because there are people I know, like friends who have all their money in their business, so they're really in one stock. Um, Even though they might not want to be, their whole livelihood is in that one company they run. Um, so there's nothing wrong with investing in one or two stocks. You just have to understand it is a bit risky, unless so it's so much just safer just to go with an index like S&P 500. I have a lot of my money in S&P 500. Um, I do individual stocks, but I'm not even sure if I beat the S&P 500. For many years, I was behind the S&P 500 because I own Berkshire Hathaway, and that was trailing the S&P 500 but now it's beating the S&P 500. So now I feel good about my investment. But for many years, I was like, I should just put in the S&P 500, all this money in this stock that's trailing it. But it's a long-term game. That's why I invest stocks that give income and will never vanish. Oh, you mean dividends? Income meaning dividends? Yeah, I mean, some people prefer dividends. I get the appeal. It's because it's tangible. You feel like you're getting returns. But
There is another aspect to dividends that I find very interesting, a point, and that is basically dividends come from the earnings, right, of the company. So they've earned it, and
right,
now it's
right,
yours. The other thing that they can do is they can reinvest it in the business, right? If they don't pay it out in the form of dividends, they need to reinvest it back somehow. So the question is, now you own a business, it made the money. Would you want to have that as cash, or would you like the management to reinvest it? And if the management reinvested, basically there's a risk that they do poorly, right? So basically you have either a certainty that you get it in the form of dividends, or maybe you get it even at a higher rate if they do well. If not, well, it is what it is, right? So it's an interesting approach. I
yeah,
don't think there's something wrong with dividends, of course. It's yeah.
yeah. Because either, I mean, generally two ways you make money investing in stocks: you get paid out in dividends and cash, or the stock price appreciates. So, like there's a lot of stocks where the appreciation in the stock price was a lot more than dividend paying stocks. But there's plenty of stocks that go down in price and they get no dividend. So people like that comfort of dividends. There's nothing wrong with that, but it's coming out of the company. So every time a company pays out dividends, it's less money for that company. So it is weighing down the company's stock price. So it's six in one hand, half a dozen in the other. It's
Yeah.
but
I think there's an interesting question coming from James. Have you tried buying a company just for the dividend? Then once we get the dividend, sell the stock. James, I think there's an interesting thing that you'll find on the stock market. There is so-called the kind of the ex-dividend date and the dividend date. Basically, at some there's a cutoff before you have the dividend, and then like if you own a company, let's say that the dividend date is 1st of January. So if you own the company on the 1st of January, you get the dividend. If you own it on the 2nd, it doesn't matter. So everybody who owns it on the 1st gets the dividend. Well, guess what happens on the 2nd? The share price drops more or less for the amount of dividend. So if you bought it in order to get the dividend, and you kind of get the dividend, that's how why you hold it. The share price will drop and for the same amount. So yes, you'll get the dividend, but you get less in the form of cash out by selling the share. So it's not a strategy that works. You cannot buy a company, get the dividend, and sell it right away in 2 days.
Yeah, it doesn't make a difference financially. You might get lucky. I mean, the stock just may go up because they had really good earnings or some good article, and the stock goes up a lot, and you get your dividends. So it's not that, or
That can go
opposite
both
occur.
ways, right? I mean, that can go both ways. And then in that case, if it's an article or something else, then it's not really related to the dividend itself, right?
Yeah, but selling for the dividend, there's no mathematical benefit
No.
doing that. You might be able to there are benefits which I don't know if we can do, but you can buy like on the London Stock Exchange and sell on the New York Stock Exchange. There might be arbitrage opportunities, but that's just so difficult to find and to execute. I wouldn't even try it. But it looks like you're looking kind of like an angle for dividends, and it doesn't work because what yeah but that's interesting. These are the things I think of too. I think of all these kind of scenarios, and but you should look at it like if you want to, like you should look at a stock's price a week before the dividend and track it, and then after the dividend and see like a number of different stocks and see what you have benefited from buying and selling.
Yeah, I mean, there have been a lot of studies on this, and it's quite clear that it's not something that works. Otherwise, everybody would have been doing that, right? I mean, these are really low-hanging fruits in a way if
Right.
it worked. But
If
also
it
keep
did
in
work,
mind that there's
it
the
would.
transaction cost as
Yeah.
well. So
Yeah. Pretty much anything that is known, the arbitrage will be squeezed out and you wouldn't benefit from, unless you can identify something before other people do, which is hard. It's not impossible. That's what I try to do on my channel. Talk about like go through the financials and try to find things. And if you could identify things like a lawsuit, a pending lawsuit, or like with the banks, I did a video on the banks. Remember, I can't remember what those banks. Key Bank was it? The banks that just went bankrupt in California last year, and it's because of all the short-term loans they had, and the long-term loans and the short-term deposits. Like if you could have identified that and shorted the stock, but it's so hard. Everything's obvious after it happens, but to figure it out
yeah, and
seems so hard.
I, by the way, I don't engage in shorts. I think even if something looks bad, it can be fixed, and then you lose money. And it may be that the market takes way too long to react, and then you pay interest in the meantime. And so for
Yeah,
me personally, I don't engage in shorting. If I'm not comfortable, I would just keep it in cash for a short period of time until I find something that's worth investing in. But it's it's not something for me. Scott, shall we wrap it up? It's been
yeah,
getting close
yeah.
to 2 hours.
But Gachi made a good point. If you do sell the stock, you'll pay higher taxes. Then I think you have to wait 3 months on a dividend after you receive it to pay the
I mean, it
capital
depends on the
increase.
countries, but if you lose money on the capital on the share on the stock itself, maybe there's a tax deduction. So eventually you wouldn't be far off from what you paid anyway. So it's not anyway, you're not making money, which is
Yeah.
I mean point, right?
But it's just another
Thanks,
thing to think
Victor,
of.
for attending. Thank you, James,
Yeah.
Gachi, Neil, Ben,
Yeah. Thanks
everybody
everybody.
else.
And sorry, Ben, again, for if I brought up a topic that's sensitive to you. I'll consider that next time. And but thanks everybody for joining, and Costa especially. Appreciate the time, and talk to everybody soon.
Thank you.
Okay, bye.
Bye bye.